Now, the question is, what do all these numbers mean? The whole goal of getting all of these numbers is to figure out how much is left over to determine how much money the business is actually making. This is where we get to EBITDA, which remember is earnings before interest, taxes, depreciation, and amortization. Again, EBITDA is often what people mean when they say net profit. When they say net profit, they're almost always actually referencing EBITDA. So just keep that in mind. But the calculation for it is you're going to take the gross profit minus the expenses to determine what the EBITDA or the net profit is. Another way to do it is you're going to take the revenue minus the cost of goods, which gives you the gross profit, minus the fixed expenses equals EBITDA. So let's do an example here as well. So let's assume that a business has $1 million in revenue, $500,000 in cost of goods sold, which means it takes $500,000 to make that product or deliver that service. And then $200,000 in fixed expenses, which might be rent, salaries, etc. So we're going to take the revenue minus the cost of goods minus the fixed expenses. In other words, revenue minus cost of goods is gross profit. So we're going to do 1 million revenue minus 500,000, which is 500,000. That's your gross profit, minus 200,000, which gives you $300,000 in EBITDA, or for the sake of normal business conversation, $300,000 in net profit, $300,000 in profit. Now, just to separate what the difference like technically is between EBITDA and net profit is how much money the business actually gets to keep after all of the costs of doing business. So it's essentially EBITDA minus the things that are in the ITDA portion of EBITDA. So minus taxes, interest, depreciation, amortization. And I'm not going to do an example because I'm not qualified as a CPA to actually tell you what is typical with taxes, interest, depreciation, amortization, how much you can actually write off, what your taxes are going to be. So I'm not even going to try to do that. But what's important is to understand that in business, it's not simply enough to count on what the business has at the end of a given time period. You need to account for taxes and other savings at the end of the year. So for example, with EBITDA, if you have $300,000, chances are you're going to have to pay taxes on that. And it's just good to keep in mind, I don't actually get to keep all $300,000 of this. I'm going to have to pay probably some of it in taxes unless I'm super good working with a CPA and I can write off $300,000 worth and I don't have to pay any taxes, etc. So the purpose of this slide is just to differentiate the difference between them. There's going to be a survey that you'll have later where you'll estimate what your net profit is. Don't go like so far deep into that. Just guess, you know, and that'll be good. And if you like are in a position where it's end of year or something and you need to calculate for taxes, actually get a hold of your CPA and figure out what that number actually is.